Well, our next guest is the biggest bull on Wall Street going into 2025. Earlier this month, Oppenheimer set its price target for the S&P 500 for 2025 to 7,100 by year end, citing the Fed's success in changing rate policy as one of the factors providing resilience for the market. With the FOMC's hawkish pivot causing such a massive reaction in markets Wednesday, could the Fed now be a risk to that momentum? We've got the strategist behind that call. Friend of the show, John Stoltzfus, is with us now, Chief Investment Strategist at Oppenheimer. And the note you wrote going into the Fed meeting, I think the title still applies, John. Where are we now? I think that's even more apt after the Fed, as we are facing down a potential government shutdown. Where are we now, John?
Great point. And Julie, thank you for having me on the show. Well, where are we now? Indeed, we're in a process here of, can we say it? Yeah, it's a transition. And the transition is to a normalizing of interest rates. It's never easy after a period of high inflation. For those of us who've been, in my case, I've been in this business for 41 years. I came in when Paul Volcker was in his second term with much higher inflation rates at that time, and then had to live through almost 15 years of Alan Greenspan, which was like a science project. Based on where we are today with Jerome Powell, a Ben Bernanke legacy, it's remarkable that the Fed has been in a Fed funds hike cycle from March of 22 until September of this year when it began to cut rates. And it didn't produce a recession. And the other side of this is the market does not like that the Fed does not want to cut as many times as the market wants. And when we say the market, we particularly mean the fear and greed end of the market, the traders, the day-to-day people, whether it's at a major institution or somebody trading at home. Everybody wants the VIG to be less or the margin to be less. And this was a tantrum as far as we can see. And we think the market is already suggesting that we're getting good potential for a nice turnaround here, because the VIX is now down about 19% after having spiked, I think, 116% since December 9th.
John, such a great overview as always. I've only been covering markets for as long as we've had Jay Powell as the Fed chair, so I don't have the perspective you do. So I'm hoping to just get a little bit more. Contextualize this sell-off for us, because everyone keeps saying the biggest Fed day sell-off since 2001 and making it into such a big deal. Is it that big of a deal?
You know, I don't think so, but I think it's a great headline maker. It's a great thing for traders who are trying to move the market and into positions that they're trading on, and the overall fact that a lot of people within a certain group within the markets would love to have lower interest rates sooner, particularly people who are investors with that use high leverage. This has not been their time. I mean, today, with margin as high as it is, essentially, the fast money players, if their bet goes wrong, not only are they at a loss, but then they got to pay the VIG or the margin, so to speak, which makes their losses worse. If they're right on their calls, the margin reduces those gains. So we think that's part of what we're seeing. The wonderful thing is the fundamentals remain intact. And I was listening a little earlier to the show, the economic data crossing the tantrum, not the tantrum, but crossing the transom, counters the tantrum in that essentially things are getting better. We've got an economy that continues to show resilience in business and the consumer. Jobs look decent. Everything is slowing a bit because, well, the Fed had raised rates for quite a while, 11 times with 9 pauses at the higher rate before it began cutting. But now it's beginning, we think, judiciously cutting to try to avoid Powell will have to deal. He doesn't want to deal with an Arthur Burns kind of situation where we get a blowback in terms of inflation. So I think that we're headed in the right direction. And I think, by the way, it's great that you've been covering this, with the Jerome Powell period, because this is a very interesting period. This kind of transition is never easy, but the Fed's mandate to produce an economy that grows without untoward levels of inflation, yet keeps employment at full employment, which the Fed defines at somewhere between 3 to 4% unemployment to allow for transitions in jobs, whether it's the job seekers or whether it has to do with corporate decisions. They want to keep things on balance.